That there's still a lot of uncertainty in the world and in the markets. And so I'm generally concerned that there's a lot of chop. And so I pick something that's pretty conservative, but I would have a combination of cash and the front end of the yield curve. So T-bills all the way up to 2-year bonds. So you can generate 4.5%, probably by the end of this year, 5% pretty safely owning this stuff while you wait for things to become more certain. And the way that I think about it is that I would rather miss the first 10 or 15% of a rally once we're really done this stuff than try to overcorrect and try to pick a bottom, just because I think that you could lose a lot of money. So I think the goal for this year is to stay resilient and in the game. And so having a bunch of cash on the sidelines ready to pound it in. Meanwhile, a portion of it, collecting 5%, is not such a bad thing while you wait for the bottom.
Fantastic.
Yeah, my answer was actually very, very similar, which is if Kashkari is right, that rates are going to 5.4% in Q1, why wouldn't you just put all your money in short-term T-bills? You earn 5.5% risk-free.
Yeah.
Like, set it and forget it.
Yeah.
And that's why capital flows are moving hugely right now from equities into bonds, especially if we're going to a recession, which is inherently deflationary.
What do you got, Freeberg? Performing asset class of 2023.
One of the things, so I think it's inevitable that we continue to have significant infrastructure spending from both the stimulus and security point of view. So, we kind of want to continue to stimulate the economy and support growth. We want to continue to create jobs and support this transition. If the recession predictions play out true and the job market does loosen, it's very tight right now. There's going to be even more of an impetus to continue to do infrastructure investment. But I think there's also these big economic transitions happening underway right now with pharmaceuticals, with semiconductors, with energy. There's a lot that we've talked about where there's a security problem and a redundancy problem. And so, there are a couple of ways to kind of play this infrastructure spending thesis in each of those areas. I've kind of highlighted 4 of them. One is in semiconductor capital equipment, so like Tencor, Applied Materials, that range of businesses that provide and sell the equipment into the fabs and the organizations that build semiconductor manufacturing facilities. The second is kind of in oil and gas services, so similar to what Sachs said earlier, Schlumberger, Baker Hughes, that class of businesses I think benefit in this environment, and this is independent of kind of economic conditions, certainly, because these are big multi-year spending projects. The third is in the equipment to support them, so Deere and Caterpillar. And then the fourth, I think, is an important one. I'll talk about this in a minute with respect to my biggest kind of anticipated thing for next year, which is in pharmaceutical infrastructure, so Thermo Fisher. And there's some company and others like them because there's a lot of build-out happening to support these big transitions happening in the modalities that are being used in pharmaceutical drugs and diagnostics. And then I think that there's also a couple of these businesses that are diversified, like Danaher, Honeywell, Thermo Fisher is a good example, that play across multiple of these opportunities. So those are all great businesses to own, and you don't need to worry about, they're growing, cash flow positive, dividend paying companies, and you don't need to worry about, am I getting 5% or 5.5% based on the equity price this year? These are long range businesses that are building real value, growing their top line, and compounding value from within. And then they're acquiring a lot of smaller businesses very cheap. I'll say that's an important trend I've seen across these companies, Danaher, Honeywell, Thermo Fisher. They buy small companies, they pay very little, and they immediately get massive return on invested capital. Like they're in the high teens. So why get 5% on T-bills when you can get high teens ROIC on the management teams running these incredible platforms? So that's where I'm most excited for this year.